One of the biggest lies banks tell us is that our money multiplies in our bank accounts. The reality is, while money increases in number due to interest, it doesn't actually grow in value. With inflation skyrocketing and bank interest rates falling short, keeping your savings in the bank is like watching it evaporate. In this video, we'll introduce you to 6 assets that will prevent this loss of wealth and assist you in building wealth for future generations. Before we jump into this video, if you haven't hit that subscribe button yet, go ahead and subscribe for more finance tips. 1. God's money. People have always thought of gold, silver, and platinum as special kinds of money called God's money. This is because, unlike regular money that can lose its value when governments decide to make more of it, these metals keep their value over time. Think of it like this. When more paper money is made, each piece of paper buys less stuff because there's just so much of it around. But with these precious metals, that doesn't happen as much. They're like a savings account that doesn't get smaller over time. In fact, as prices for things go up, that's called inflation, the value of gold, silver, and platinum usually goes up too. For example, long ago, before the 1950s, you could buy an ounce of gold for about $400. But fast forward to 2024, and that same ounce costs over $2,000. Experts predict that by 2032, an ounce of gold could be worth as much as $10,000. Not everyone likes the idea of keeping these metals in their house or a safe. It can be a hassle or feel risky. That's where something called gold ETFs comes in handy. ETF stands for Exchange Traded Funds, which is a fancy way of saying you can buy gold just like you buy stocks without having to hold the actual metal. This is a super handy option for people who want to invest in God's money without the extra work of keeping it safe. 2. Industrial commodities. Industrial goods are important because they are rare and naturally useful, making precious metals essential for different industries. For example, silver is used a lot in making electronics, medical devices, and nuclear reactors. Metals like cobalt, nickel, and copper are also in high demand for their special qualities that can't be easily replaced by other materials. Since 2020, the need for cobalt, especially for electric car batteries, has shot up, making its price jump from $20,000 per ton in 2012 to $40,000 in 2022. That's a doubling in price in just 10 years. This shows how adding raw materials to your investments can really boost your portfolio when the demand is high. However, not everyone can afford to invest a lot of money directly in raw materials, nor can they easily store them or find buyers. So, investing in the stocks of mining companies like Rio Tinto, funds that focus on mining, or even in futures and options, are all smart ways to get involved with these important industrial goods. 3. Sovereign guarantee. Have you ever really looked at a dollar bill and seen the phrase, "This note is legal tender for all debts, public and private"? Ever wondered what it means? Back in 1971, President Nixon removed the gold backing from the dollar, making it official money by U.S. law. This meant the dollar could be used to pay for anything, even though it's not backed by gold or any physical thing. Its value comes from the government's promise. Basically, the worth of your money depends on the government's stability, making investments backed by the government, like sovereign guarantees, a solid choice for saving money. Governments usually don't go bankrupt because if they did, it would mean the whole country is in trouble, which strong governments try to avoid at all costs. Investing in government securities, or G-SECs, is one of the safest bets. However, it's best to choose those from stable governments with good credit ratings, especially after seeing what happened in Greece in 2009 when international organizations had to save it from debt multiple times. The lesson here is to always check a government's strength before investing. In the US, you can invest in treasury bills, notes, and bonds for a safe investment option, often with better returns than a bank savings account. These are supported by the US government's strong position in the world economy, and even small investors can buy these securities directly from the government or on the secondary market. 4. Safe haven currencies. In today's world where money isn't backed by gold, having a stable political situation is very important for investing. This is why wealthy people often keep their money in Swiss banks. Switzerland has one of the strongest economies in the world and is politically stable, making the Swiss franc a go-to option during uncertain times. We've seen this during the Eurozone debt crisis in 2009 and the global financial crisis in 2008, when a lot of money was moved to Switzerland to avoid losing value due to falling currencies. The Swiss franc is also a good alternative to the US dollar for international business. For example, during the recent conflict between Russia and Ukraine, when the US put trade restrictions on Russia, Russia used the Swiss franc for trade. This increased the demand for the Swiss franc, making it worth more compared to other currencies. In early 2023, 1 Swiss franc was equal to 1.1074 US dollars, which means people holding Swiss francs saw their money grow quickly. Top currencies like the Swiss franc, British pound, and Chinese yuan are really good for saving money. But not everyone can open Swiss bank accounts, so currency ETFs and forex brokers, such as forex.com, allow smaller investors to start with as little as $100. 5 value stocks and mutual funds. Treasury investments are known for better earnings compared to just holding cash, but they don't bring in as much as stocks because they're safer. For those who prefer not to take much risk, this safety is key, but almost everyone aims for the higher profits that stocks can offer. The world of stocks is divided into growth stocks and value stocks. Growth stocks, particularly in the tech sector, come with higher risk due to the uncertainty of new technologies or ideas. Value stocks, like those in the industrial metals sector, are considered safer bets because their products have a steady demand. Investing in value stocks that have strong underlying fundamentals can lead to consistent growth and reliable dividend payouts. However, digging deep into the details of each value stock to assess its potential can be overwhelming for many investors. This is where dividend-focused mutual funds shine. Options such as the Vanguard High Dividend Yield Index Fund, Admiral Shares, with their history of stable dividend distribution, offer a manageable and affordable way for individual investors to tap into these benefits. Additionally, investing in land and real estate presents another avenue for securing assets. The 6th, land real estate. Accountants view land as a non-depreciable asset for a good reason. It's scarce and perpetually in demand. From the dawn of civilization, land has been a prized commodity, essential for building homes, schools, factories, farming, and commercial developments. With the world's population on the rise, the demand for land and the structures on it, like residential homes, office spaces, and commercial properties, will only increase. This makes land and real estate solid protections against inflation in an investment portfolio. A Bloomberg study shows that from 1992 to the early 2020s, housing prices tripled despite the significant drop during the 2008 housing bubble. Hence, including real estate in your investments is a smart move as the value of money declines. However, many smaller investors postpone real estate investments, often considering it only in the context of buying a home later in life. While owning your home outright is a worthy financial goal for your 40s, engaging with the broader property market is advisable at any age. Contrary to popular belief, hefty sums of money aren't necessary to get started in real estate. REITs, or real estate investment trusts, offer a way in, functioning much like mutual funds but for properties. Alternatively, investing in rental properties can be a way to generate income. The rent collected can cover your expenses and mortgage payments, potentially yielding profits as well. Withdrawal investing insights, signing off, and this is not financial advice.